Boom.
Hello, everybody. We are live. Hi, Eustis Nation. We are back again, and this time we have Timothy with us, and we're going to talk all things market. So, Mike, you want to do a quick intro?
For sure. This is my good buddy, Mr. Timothy Ieyoub. He is our capital markets director, manager, all knowing of all things, market guru. And I'm gonna really pump you up here, Timothy,
I
to make you
appreciate
feel
it. Yes.
a genius and you know all things. So just
Yes.
be ready for that. Okay. I kind of like to think of Timothy as like Scotty from Star Trek. I'm kind of a dork, so this is something that I'm really
Hey.
into because he's like down there in the engine room trying to hold all this crap together and trying to make
Yeah.
it all fit, and nobody really understands exactly what he's doing. But he's always got like some really good jokes and some funny lines.
Yeah.
It's more like the Simon Pegg version of
Yes.
that's who I really think of him. So um,
Who's a companion? The
that's
the
right.
little.
Yeah, he's got all kinds of companions over there in the secondary. So today, Timothy, because we've had a bunch of things happen in the last few days, so this topic is very topical, I guess. I don't know. I couldn't think of a word there,
Hot
Right.
but
topic.
yes, it's a very hot topic right now because markets are going all over the place. So who better to talk to about what's happening than our market director here? So first off, Timothy, again, I got to establish your credibility as the genius here. So tell me a little bit about, or explain to everybody listening, kind of what you do for Eustis, what your job is, and kind of your general nuts and bolts of your day.
I would say I won't say in charge of revenue because most all of our revenue as an independent mortgage banker comes from loan originators. But what I do is I establish our rates for the day based off of our
Hmm.
products. Once we take those locks in, I hedge them. We're a mandatory shop. We follow the process to go to closing, and then I'll put these out into the market to several of our investors, and then we transfer the servicing rights over to the investors once they purchase that asset or that loan. So basically, all in there is a revenue for the company, and so I just got to make sure that we stay above par on those transactions, up or down. Especially in these markets, it could be obviously crazy. A lot of it is you got to make business decisions, especially in these times with revenue, which we'll go into probably later in this conversation. But just trying to keep my eyes on everything, keep it together, programs, products, investor relations, just try to keep everybody happy.
And checking Saint scores in between every once in a while too.
Well, Sundays, yeah, Sundays or Monday nights. I think we probably have a good share of prime time this year as the Saints, but yes.
See, it's funny, when anybody watching this that doesn't know Timothy, you think of like secondary market guy, banker guy, he's real buttoned
Mhm.
up. He's got his nice little collared shirt on today, but nobody really understands that Timothy is he's quite the party animal. He likes to have
He
a good
is.
time. There's no lacking of fun with Mr. Ieyoub.
I find humor in just about anything, and I like to pass that along because that's the way I can cope with a lot of things
That's nice.
in general in life or work.
Yeah.
And I think it's going to be okay. Everything's going
Yeah.
to be okay. It always works out. It may be
Some.
crazy, but I use humor, as most of y'all probably know,
Yeah.
to get through the day. And hopefully you understand that,
Yeah. So.
especially if you're the subject of my humor.
That's right. Well, that's why you're one of my favorite humans. There's no doubt about it.
Yeah.
So, all right. So, real quick, we're gonna try to keep this as 101 simple as possible because,
Please do.
Tim's a real smart guy when it comes to this stuff, and he's going to use a lot of big words that half the people are going to go, "What does that mean? What does that
Yes.
mean?"
Half those
And
people, me being one of those in
right.
that half.
And even with loan officers that do this every day, I would still say the vast majority of us are morons when it comes to this stuff. So myself included. So I think it's good to kind of nail down a few little terms so that way we understand kind of where we're coming from on stuff. So first off, well, let me ask you one other question, Timothy. Tell us how long you've been doing this.
I started out in a savings and loan for most of y'all that know what a savings loan is. Back in 19, I actually started out in 1990, and then in 95 I graduated in accounting. That's probably when my mortgage career actually took off. So I guess that puts me at almost 25, 27 years of
Yeah,
doing this.
You're only like 35 too, right?
I turned 50 next month. I joined the 50 club next month. I've been with Eustis for 12 and a half years. Love it. Enjoy it. Love the people, just like
Nice.
we always know. So yes.
So you've been looking at these things for a while then, to say the least, right?
Yes. And it's been, it's interesting. You know, I learn every day I come in and I probably learn something new. And this past probably 4 months, actually, let's go back to COVID. When COVID hit in March of 2020 and rates went incredibly low, and you know, with the hedge position and TBAs, which I use to hedge, which are security instruments, it's been challenging, but it's been also exciting because you're learning new ways to make things work, to keep, you know, the the integrity of that loan, of that lock going forward. But the one thing I appreciate or enjoy the most is the relationships. So it's whether the relationships with the investors, hey, I got this, can you help me out? Or, I mean, you build those relationships and we'll get through anything. And then also the relationship with the loan originators. Y'all probably all know I love to talk about locks and this and that. If it makes sense, if it doesn't, whatever.
Hey, you're my favorite person to call when the storm's on fire. So I'm always happy to.
When I get a call from Mike Mills, I know exactly what's going on.
Never a dull moment. So, all right. So let's start off with a couple terms here, just because you've said it a few times. So I want you to, can you explain when you say hedge, what do you mean?
Okay. So we have, we taken a lock for $100,000, let's say, or let's say we take $1 million worth of locks.
Mm-hmm.
It's mandatory. So we're not taking a commitment out with an investor, which would be a best effort commitment. We're putting it into the hedge.
A commitment, meaning you're promising that loan to an investor, yet you're not doing that. Is that what a commitment?
We're not right. Correct. Okay. Some shops work best effort. They want to be protected. They take out a lock with a certain investor, and then they follow the rules of that lock based off of time frame and delivery and underwriting guidelines.
Right.
Eustis is a little bit different. We use on the other hand, is a mandatory shop, so we take in that lock, and it goes into our hedge position, and then we use the TBA securities, mortgage-backed securities, to hedge that. So if let's say the market is selling off, which it has for the past 2 days,
right,
our securities will become more valuable, but our value of our locks will go down. But at the end of the day, you're still making the same revenue, and vice versa. If the market rallies, then our value of our locks would be higher, but our securities are going to be less in value. So basically, you're hedging. Most people probably understand, hedging your bets.
You're balancing, basically. You're trying to make sure.
Okay.
And that's how we operate. And then when those loans become closed loans, we would bundle those up and put those out there into the secondary market. And that's, once those are committed, then at that point, then they fall out of the hedge.
Gotcha.
And then it's just a continuing cycle.
So
mandatory is usually a better execution.
Uh-huh.
And so what we do for Eustis is we take that better execution for mandatory and we pass that through onto our rate sheets.
Okay. So if we have better performance on our hedge to some extent, we can get better pricing, that kind of thing, depending on where the market is, right?
Yeah. So the last 2 years were interesting because the market was always rallying. It was, we got to 2.25% interest rates. So I didn't have to hedge as much.
Right.
So that was, some positive pickup again, push that pricing back through to the rate sheet. This year, the market's been selling off since January 1st.
Yep.
So with that, you have to put on more coverage, more securities. And so you have greater hedge costs. So the pickup may not be as great because of where the market is, but you're still trying to execute.
Pickup being profit, correct?
Volume 2. Yes.
Okay. Gotcha.
Another conversation to have.
I know. This is fun with Timothy because he's got all kinds of fun vocabulary.
I've really stepped into a really fun podcast about Tom, and not just talking about football. It's like there's a lot going on.
That's right.
Again, it's going to be okay.
So now let's talk about, because everybody's, today there was an announcement that the Fed was going to hike interest rates 75 basis points from where they were. That's what they came out and said. What, about 20 minutes ago, probably?
Yes.
So again, explain to the layman, me being that, and Raul,
Yeah.
what is the difference between when the Fed raises their rates and mortgage rates, how do those two things interact with each other, and do they directly impact one another?
So, and it's a good question, because some people think that if the Feds are raising the rates, that all of a sudden our rates are going to go up 75 basis points or 75, whatever. And that's not the case.
And by the way, real quick, just to clarify, because I tell this people a basis point, okay?
Yeah.
100 basis points is like 1%, right?
Right. Which I guess the Feds are doing it by rate. So I
Right.
talk bips all the time, so it's just
Right.
stuck in my head. So they're raising the Fed rates by 0.75.
Okay, sorry.
And so that's just the cost to the banks, or the borrowing cost. It raises interest rates, and as we all know, they're just trying to slow down people spending money to try to get this inflation in line. Yes, at some point it does filter down into our rates, and our rates would go up. But today was interesting because, as you know, on Thursday I think we were humming along, and the consumer price index on Friday was hopefully going to show that some of the steps that the Feds have taken has slowed down inflation. That was not the case. Market sold off. When I say market, the mortgage-backed securities market sold off, because basically you look at we use the 10-year Treasury as kind of like a focus point, or I do. The yield on that went up, so our rates got worse. That happened through Monday. Yesterday it was okay. Today we came in, it rallied because there was a report. I think the price showed that some of the higher end auto, the purchase of auto cars maybe had slowed down, which is a good, okay, maybe the inflation's going to start coming back down. And then they raised it 75 basis points, or 75 today, which I actually thought would make us a little bit flat. I thought if they would go 50, we might sell off, but 75 basis or 75 move, I thought we could stay where we were this morning. It did drop a little bit. I'm looking at the screen. Our race got a little bit worse, but it kind of seemed to start coming back a little bit. So we've maybe weathered this storm for now.
So when we look at the Fed funds rate is what institutions like banks, what they pay to borrow money from the Federal Reserve, correct?
Yes, correct. Okay. Yes.
And whenever the Fed raises that rate, that means that it costs banks more money to borrow funds, which then in turn, if you're going to get perhaps a car loan or a credit card or whatever the case may be, that the rate to borrow that money on that instrument is also going to go up, because the bank is being charged more for their rate, or for their money as well, right?
Yes.
So then when it comes to mortgage-backed securities, which is what mortgage rates are actually based off of, not the Fed funds rate. The two interrelate for sure, because all market, impacts each other. It's not something that's just isolated. So the mortgage-backed securities, when they go up, interest rates go down. When they go down, interest rates go up. They're inverted. Yes. So, and again, talking simple dummy terms, because this is who we're talking to here. When we look at that, you talked about Treasury yields. Okay, so explain to, again, the dummies out there, myself, how Treasury yields and yields, by the way, are profits that you earn, or interest that you earn on a Treasury bond over a period of time. How do those yields affect or relate to mortgage-backed securities, and those two, like when you judge Treasury yields of the 10-year Treasury or whatever it is, how is it that indicates what could possibly happen with mortgage-backed securities?
It's almost always like a frightening question, because I always have to sit there and think about it again. Okay, yields up, prices down, it affects this. Like, you have to draw it out, because in theory what's going on, or you see it, but when you try to explain it, it's kind of a different thing. So I put it in my way, which may be layman terms.
Please.
Okay, so the 10-year, the yield's going up. So what does mortgage-backed securities need to do? And I always say they need to be sexy. So how to be sexy? They have the price goes down and the yield goes up, right? So if the mortgage-backed securities price is going down, that means our rates are going up.
Gotcha.
To add to that, and this is, I think we'll just go into this conversation, what's happening right now to me is that these mortgage-backed securities are not the higher coupons, which you have mortgage-backed securities go into certain coupons, a 3 coupon, a 3.5, a 4, 5, 5.5 coupon. The higher coupons aren't trading right now, because there's is this thing really going this high? Are these rates going this high? Because if you think about the investors on the back end of it,
Mhm.
they don't want to buy high interest rate loans. They don't want a bunch of 6.5% interest rates.
And why?
If in 2023 we have a recession,
Right.
and rates come back down, because then every 6.5% interest rate might be now 4.5%, and everybody's refinancing.
Right.
Well, if you refinance, then that principal balance goes away, and then the bond guy at the end doesn't get his full. He'll get his principal, but he won't get what he expected as far as the interest, the rate on return on that. So right now, the pricing is all, to me, it's just compressed.
Right.
And so when people go out there and they try to price, especially like the government loans, there's just no price out there. It's just getting squeezed because the higher coupons aren't traded.
And the higher coupons are the ones that are represented by the higher rates, essentially.
Like, well, they go into the higher rates go into those higher coupons.
Got it.
But like I could look right now in the 5.5 coupon. Well, it kind of is a spread now, but yesterday I think the 5.5 coupon was trading the same as the 5 coupon.
So let me ask you a question. I explained this. Somebody asked me this the other day, and this is kind of how I explained it. And you can tell me if I got it right or wrong here. But so I was pricing out a loan, and this was yesterday, and the rates were, credit was okay. There's a couple of things in there, but it was a conventional loan, 20% down. The rate was 6.5%. That's what it was. Okay.
Yes.
But in order to get that rate, there was discount associated to it.
Yes.
And in my head, the way I looked at that is because I'm going off what you said was that, well, the reason the rate's not 7% or whatever the number may be and have what we would call par, right? Because from a lender's point of view, whenever we price out a loan, there's something called a par rate, which means you don't have to pay anything to get that rate, and your rate you don't get any credit for that rate. Right in the middle.
Right.
So the reason that I couldn't hit a par rate on that was because of what you said, because the investors are looking and going, well, yeah, we could jump the rates up to 7% or whatever it is, but we have a serious fear of in 6 months, 8 months, 12 months, we're not going to earn the interest that we wanted to earn off that loan because it's going to be refinanced into a lower rate because the rates are going to go down or adjust or whatever. So instead of raising the rate higher, they make you pay that discount point because there is a greater cost for that interest because the market sold off, but they're not going to build it directly into the rate. They're going to charge you more of a cost because of the fear that in 6 to 12 months when the market adjusts that the rates will go back down and then they lose that loan because it gets refinanced. Is that correct?
Right. It's and they call that prepaid speeds. What are the prepaid speeds? If you think about everybody that refinanced at 2.25%, 2.5%, 3% the past 2 years, they're not refinancing.
No.
Unless they're selling the house or there's a death or divorce. I think maybe the 3 reasons that would happen. But if they're not, and that's the other thing about housing sales. I mean, are you selling your 2.5 interest rate to go to 5.5% interest rate at a higher value or whatever? But those aren't refinancing. So think about those investors or those prepaid speeds are basically nothing. Like they'll be there for the duration of that security. 6.5%, 5.5%. I mean, we do think, I think that rates will eventually come back down. And even if you go from 6.5 to 5.5, the rule of thumb is that you refinance if you improve your rate by 1%. That could happen pretty quick.
Yeah.
I mean, not like tomorrow quick, but it could happen in 6 months or beginning of next year. And then if you have that happen, then again, all of these loans are going to refinance and we have another refinance boom.
Right. So whenever it's always fun to me to talk about this stuff simply because it's hard. This kind of stuff impacts every person's life on a day-to-day basis, but so few people understand how it all works. And there's a certain level of, it's almost like it's like law, right? When you write really complicated laws that have to be interpreted, the only person that can interpret it is an attorney or a lawyer.
Right.
So therefore you put all the knowledge and information to a select group of people, and the average American has a really hard time figuring this stuff out. And I think it could be simplified, but there are so many moving parts and so many different, levels of the market that, interplay with each other that it gets difficult to fully understand what's happening and why. But from your point of view, Timothy, since you've been doing this for so long, let's go back to 2020. Okay. When COVID hit and everything kind of, started changing pretty dramatically and pretty quickly. How did we go from where we are there to where we are now. And I want you to talk a little bit about how money, with rates being so low for so long, money has been so cheap. A lot of people, when they talk about inflation, I hear the stimulus checks. Oh, people got this $1,200 check, and that's why we're dealing with all this. And I tend to argue and say, look, a $1,200 check one time to
it doesn't do much.
No,
Mhm.
it's the cheap money is how we got to where we were. So talk about the history of how we got here.
I mean, nobody was working, nobody was spending money in COVID, and so the Feds had to do something to keep the economy going, and they had to stimulate the economy. And a big part of the economy is mortgages and everything that's around it. So one of the things they did, they stimulated it, and it got a lot of people moving or maybe buying houses or definitely refinancing. I think you're right, Mike. The $1,200 stimulus check is not going to be the reason that we have the inflation that we have today.
Right.
But so we come out of that, and then inflation starts going up. And there's probably all the talk that the Feds were kind of behind the eight ball, or behind in implementing this. But now you got an unemployment rate that's pretty low considering. And so what are people doing now? They're probably still spending money because they didn't have that money 2 years ago.
Right.
I mean, we've all done that. Like, you don't have money, and then all of a sudden you got money. What do? You take a trip, you go buy a car, you do all that other stuff. So now these people are still spending money. They're still spending, as we can see with the report that came out on Friday. And that is probably where that has to, eventually slow down, which, again, the report this morning that the higher cost goods were slowing down, and what happened? Our market rallied. Okay, inflation's, but we're not out of the woods yet. And so with these rate hikes, but a lot of people want it to be instant gratification, I guess you could say, like, okay, we're out of the wood, rates are going to go down, but it's going to be something that's going to be continuing. And the last thing you want to do is get in a recession as well. So, there's still, I saw interesting, I read a lot of commentaries every day just to try to learn and understand more.
So you can make decisions, right?
I think there was two, out of four business banks, two of the banks said there was going to be a recession, and two said there wasn't going to be a recession.
Right.
So 50% chance of rain. I mean, so you don't, I think what's been the most difficult is, I usually have calls daily. Hey, what are rates doing? Should I lock? Should I not lock? What should I do? And it's tough to answer those questions. You can only say we were kind of moving along for the past couple of weeks. Everything was good. Prices had stabilized. Volatility kind of came out of the market, and then Friday hit, and it's just been
bloodbath.
I can't get that par rate.
Yeah.
I checked the rate on Thursday, and now I'm 200 basis points off. What happened? And it's that. So hopefully we kind of swing back the other way. I usually see some type of correction. Now it looks like we're kind of rallying back. I'm looking at the market. It looks like we're coming back.
Oh yeah, a little bit.
So I think you have to do things based off of what's happening in general. And I think it was right in COVID. You had to keep it going. People were losing their jobs. You try to stimulate the economy, and then that COVID is hopefully under control. And then now you're swinging the other way, and you have to address it. So they kicked that can down the road, which was probably the right thing to do. Now you got to pay the price, and hopefully we can get it back under control and swing back in the middle. And then we'll look and say, okay, everything's fine. I do say this, I think before COVID, we were at a 5 and a 5.5% interest rate before COVID. So we could say, as a mortgage industry, a lot of people got some good deals over the past 2 years. And I don't want to make light of COVID that, we don't want to benefit off of something as tragic as that. But people did get some low interest rates that they can have for 30 years or whatever. And so if that never happened, which I wish it would have never happened, but if it didn't, we would probably still be maybe in the same rate environment, which would be 5.5 or 6. So it's just, I think what the shock is that it happens so fast.
It's perception and expectation, right?
0 to 90, 0 to 100, so fast, and you quote a rate one day and you come back the next day and it's completely not there. And what happened? And it's just market movement. And so It's you just try to give the best. This is what I
Mhm.
see. This is what you should do. Let's do it. And then that again, I'll lead into probably the next conversation is applications and loan sales. Yeah, I think it's refinances.
Mhm.
Rate term refinances are like less than 10% now.
They're dead.
They're dead. I mean, who's going to refinance? Cash
Yeah.
outs. Cash outs are there
Cash outs are there.
um,
A lot of
to an
equity.
extent, and then purchase money shops.
Yeah.
I think Eustis Mortgage has always been a purchase money transaction shop.
Yep.
So I think we're hopefully insulated. We're never insulated, but you have a lot of people now fighting for that same borrower now, and so
Mhm.
I'll go into another term that we're talking about: a competitive compression. Who's working for what?
Right.
We don't. Everybody has kind of the same rates, but if this guy's working for cheaper or this guy's working for
Right.
more, it's going to affect mortgage rates.
For sure.
Yeah.
Now, when we talk about our industry as a whole with housing and real estate, a lot of people that don't do what we do every day, their favorite word nowadays is bubble. Like everybody likes to talk
Mhm.
about bubbles, and because we went through, still in our adult lifetime, it wasn't that long ago that we had the big crash in 08, 09, and
Yeah.
everything that came after that. And so when people think about high rates and high prices on homes, the default is to go back to what happened then and say, oh, well, we're just in a bubble and this is all about to come crashing down. And I want to talk a little bit about why that may not be the case, because when you look at, I think bubble can apply to a lot of other things. When you look at the stock market and when you look at, my favorite thing, which is cryptocurrencies, there's certainly some bubbles involved there, but I think that related to, again, the cheap money. When you can leverage whatever assets you may own, whether it be stocks or Bitcoin, and you can take out loans against that at a very cheap price and buy more, that tends to inflate the prices of those assets, which then when money becomes more expensive, they deflate and the bubble shrinks, right? But I think we're different. I think it's different right now when you talk about mortgages and real estate, because the two things that affect the price of homes and everybody thinking there's going to be this massive crash is just basic economics, right, Tim? Supply and demand.
Right.
So how
Right.
many houses do we have available and how many people are
Mhm.
trying to buy homes,
Right.
right? So when we look at the demand side, because that's where rates play a role, as rates go up, the demand for real estate can go down for sure, because it becomes more expensive to purchase a home. The money outlay needed, the income needed to be able to do that. If income's not keeping up with prices of houses, which right now it's not really doing that, that can certainly affect demand. But the bigger issue that we're dealing with in our industry is supply. Houses are available that people can actually purchase, and in our market in DFW and in your market in New Orleans, the supply side, I think I read something the other day that we have a 2-month supply of homes available for sale in our market. And an average decent balanced market, you have to have somewhere between 4 to 6 months of supply available. So we're not even close to where we need to be as far as supply of homes available for the average consumer. So this idea that there's a bubble and that these prices are so inflated and that they just need to wait until the pricing comes down or the home
Mhm.
prices come down, I personally don't see that as something that's going to be happening anytime in the near future, because again, unless we have massive foreclosures, which
Yeah.
right now the foreclosure rate's less than 1.5%. We don't have delinquencies on mortgages. We have housing starts where we have builders that are not building homes, they're building multifamily homes, not single family homes. So there's not a whole lot out there that's indicating that this supply side is going to change on housing right now. So the only thing that could change dramatically would be the demand. So Timothy, from your point of view, where do you see the market going as a whole? Do you think prices will change? Am I missing something? Do you think that the rate being higher is going to seriously affect the demand? I mean, you've been doing this for 25 years. So what do you think?
I think the I do supply and demand. I mean, that's the basic economics. The I don't think there will be that housing bubble because back then in '08, you had all the different types of loans, and you had to basically had a pulse and you could qualify for an $800,000 loan. We've had prudent underwriting since then. The loans we underwrite now, solid loans, performing loans that can probably withstand any type of recession for the most part. So I don't think that housing bubble will happen. I am concerned that sometimes people won't qualify for mortgage loans based off of the higher interest rate, and then some of the insurance premiums that I'm seeing coming in. So those two things, when your insurance and taxes are more than the principal and interest balance of the loan, to me that's a concern. That's like if we just could qualify off of principal and interest. I mean, again, I don't want to take away underwriting, but everybody could probably afford a principal and interest home. It's the taxes and insurance that I think are going to play into whether home sales will be back to normal or the supply or if you can sell or not. Because again, if you're selling a house right now, where are you moving to? I mean, you might be moving to a different town, but are you moving, like if you're here in New Orleans, where are you moving to if you're selling your house? There's nowhere, there's not new construction. You're only going to be moving and going to get a higher interest rate and higher property taxes because now your house is based off of the sale of the house.
And a much higher price.
Yeah. So it's, again, I have seen some loans where come across my desk where the debt ratios are tight because the interest rates aren't there anymore, that they may not qualify for that home. So it's just something else to think about.
So I have a question. Somebody in the market right now, like what should they focus on? Like rate, price, or what you're talking about, like insurance and tax?
I think you have to go in knowing the whole, I mean, it costs to buy a house, and you have to go in knowing all of that stuff. You can look at it and say, oh, it's a $200,000 house, that could afford that. But
where's
what are
that house?
taxes and insurance, taxes and insurance on that? You have to be aware of that. Now, the flip side of that, is that, I think rents are only going up. So if rents are going up, you might be paying less for a mortgage loan than you would be paying if you pay for rent. So you just have to look at it all, and definitely see a Mike Mills or a loan originator before you even go looking, and get pre-approved and know exactly what payments would be. I mean, we have all these tools now that will tell you what your all-in payment's going to be. Make sure you're comfortable with that. And then you can go shop knowing that there's not going to be any surprises.
So as far as like prices, though, I also heard that, prices don't really ever go down.
That's
like interest rates fluctuate, but prices don't. Can you talk about that?
There's a graph that I've looked up the other day. I don't have it in front of me. I'd show it to you. It's from the St. Louis Fed, and it kind of showed the pricing on homes, the average median price of a house in the United States from like 1965 to today. And the chart goes like this all the way. Okay. And now it goes like this, and then it goes, whoop, jumps way up.
Oh, wow.
There's one spot in there, one spot of significance where you see a dip in housing prices. If you can guess when that is, it's probably pretty easy to figure out when that happened, right? 2008, 2009, crashed, right? That's the only time in that entire scale where there's been a significant reduction in the price of homes. And within a 4-year period, it was right back up above where it was.
Yeah.
So what I tell people all the time is like, look, if you're concerned about the price of the house and you think that if you just wait a couple more months, or if you just wait 6 more months or 8 more months or another year, that the prices are going to come down. There's nothing in our history that has indicated that that's the case. Okay. Could it happen? Is it possible? Of course. I mean, aliens could land on Timothy's front yard tomorrow. Anything's possible. Okay. But
they were there this morning, actually, I think.
But it's very, very unlikely that that's the case. So the only other decision then becomes, okay, well, what about rates? Well, rates are something that as a consumer, you really can't control. And if you try to time it and try to figure out when the best market time to buy the house is, it's going to limit your ability on what you're buying. Because at the end of the day, what's the most important part is where the house is, the timing of, did you have to move for a job? Do you need new schools for your kids? Did you not like the neighborhood you were in? Are you tired of renting? All of those things play a role. The rate is something you can't control as a consumer. So the good news is, though, with the interest rate, is it changes all the time too. I mean, we've been from 20% to 2% to 6, 8. I mean, it goes all over the map.
Yeah.
And so if you buy a house today and your rate's 6%, that doesn't mean that that's your rate for the rest of your life.
Right.
Okay? Rates are only a function. I say this all the time. Rates are a function of time. They're not a function of money. Because if you have a 20% interest rate on a credit card, but you never carry a balance on that card, you don't pay any interest. Okay.
Right.
If you have a 3% interest rate on a $300,000 loan and you live in that house for 30 years, you're going to pay a lot of interest, not because your rate is high, but because you've been in that loan for a long period of time. So if I buy a house today at 6.5%, and I live in that house for 2 years, and we go into a recession, and the market comes back down, and rates go back down, I have the ability to refinance that home, get the lower rate, and bring it down. Okay.
Right.
But if in turn I waited 2 years to buy the house because rates were too high right now, and I thought prices were going to change, well, even if I bought it at a lower rate, maybe in that period of time I did save some money with the interest, but now the house is 20 to 30% more expensive than it was if I'd have bought it 2 years. Okay. So even with the appreciation that we've had in the market over the last, 5 years, where you're looking at 20, double digit appreciation rates across the country, is that going to continue? Is that sustainable? Probably not. Okay.
Yeah.
Probably going to come down, but that doesn't mean that the prices are going to go down. It just means they're not going to go up at the same rate.
Right.
Okay?
Right.
So,
and look at it as an investment as well.
Yeah.
Everybody, you aren't going to go sell your or liquidate your 401k right now because it's off 30%. You're just going to let it ride out because historically it shows it's going to go up in value.
Yeah.
It should, right?
Well, and when we're dealing in a market with inflation like we have right now, okay, there's very few things that are a hedge against inflation. And one of the best hedges against inflation is real estate, because as the price of the home goes up, all right, whether it be just appreciation or inflation, so does the value of your property. So the value goes up every single day. If I had $100,000 and I put it into the stock market 6 months ago, I would have lost about 50 grand on that money as of today, because that's how far it's fallen off in some cases. Okay. But if I put that same $100,000 into a piece of property, now it may not be cash that I can go spend tomorrow, but the equity that I picked up over that period of time because of inflation, like inflation actually helps. If you bought properties 5 years ago, the 8.5% inflation that's affected everything in our economy is now also affected real estate. So it's raised it up. So it's the money that you have available to. That's why we encourage people to get investment properties, second homes, your primary residence. Use real estate to protect your funds in a time of volatility, because that money that's sitting in the stock market or that's sitting in Bitcoin, like me, that money is taking a hit right now. Now, just like all things, it'll probably bounce back, and everything's about a long period of time and a long scale. But at the end of the day, if you want to protect your funds and your money, real estate is the best place to put it, regardless of what the interest rate is.
Right. But also that money's protected right now as long as you don't pull out that money right in your 401k.
You don't lose money until you sell. That's when you lose. If you own Tesla stock today or you own Bitcoin today, you don't lose your money until you sell it.
Perfect.
So Timothy,
and I think this is a good time too to also plug renovation loans, because you can go buy a house that's $50,000 that's fallen apart and put $200,000 in it, and that thing's worth probably $350,000. So a lot of people think they need to go buy a move-in ready house. I say you can find some bargains in some neighborhoods, do a renovation loan, roll it all in, one-time closing, and that's another way to acquire some real estate.
So the question, Timothy, then is, where do we go from here? So today, let's take another little quick check. Now that I'm looking at it,
we are back up to where we started.
Whoop,
yes,
whoop.
Yes.
Rates are getting better.
You see, it digest the news, kind of think about it, and then back up to where we are. So
what is it that would cause rates to go back down? What is the thing that is most prevalent when it comes to saying, okay, when are rates going to go back down? What do you think, Timothy? What's on our horizon here? What's the time horizon for that?
I think we just got to get some positive news that the inflation is in check, which I'm not certain when that will happen.
I'm hearing October.
It will take, but if that can get in check and you remove volatility from the market, and then you get investors, especially on our side, you get investors comfortable with pricing. It's another component of our pricing. I mean, is a secondary market. What are their pricing? They don't. They're going to push more, kind of what we call margin back into the price. I think if we can remove, if we, like the past 3 weeks, we were doing pretty good. We were in a good marketplace. People were pricing. We were taking locks in, and then Monday happened. If we can put all this behind us and get volatility out and start seeing some positive news on the inflation, gas prices start coming down, maybe something like that.
That's wishful thinking there.
I know. I mean, it's just crazy. But if we start just seeing some,
Right.
not drastic drops, just level and maybe start, then I think we can ride this out. Then you start seeing some. You're not going to see lower rates like 3.5 or 4%,
Right. Right.
but you
Right.
might see
Reasonable.
some more attractive 5% options, especially on investment and second home.
Do you think we
But
really need like a certain amount of stability where, because you and I talked about this before, where it's like, well, when the rates go up and down, whatever direction, down, up, whatever, it really causes issues for mortgage banks and the how these rates are judged simply because nobody knows where it's going to go. If we
right,
don't know it's going to go up or we don't know it's going to go down, then everybody's a little tense to hold. Do I want to get into this? You know, I'm talking
Mhm.
about investors, not buyers and
Yeah.
sellers. But so do we need more stability? You know, need a couple of months of keeping rates at 5 or 6 and not having big jumps and big swings in order for it to get kind of more settled?
yeah, to me that's a pickup. So even if we stay in the 6% range, I'm okay with that. If it's stable, if
Right.
it that's where
Right.
we're gonna be in 6%. That's okay. To me,
Right.
that's a pickup, especially um, in this market. It's these swings that we see. We saw it at what, in January. We saw the big swings. Then you kind of saw it settle down. And when I say swings, it's more sell-offs and rallies. And I think that's really what just jolts the system, makes our rates go out of whack, and then it,
Yeah.
it probably puts questions into borrowers' minds. Is it, should I buy this house? Should I not buy
Yeah.
this house?
Right.
Yeah. So what you're saying those we shouldn't be scared right now because I was on YouTube doing some research for this and I just saw a lot of thumbnails on like this huge bear market and if we should be scared or not. So enlighten us.
I like Mike said, it's an investment. I don't think you
Yeah.
need to be scared. I think you need to just say, does it make sense? Does it make
Right.
sense? Everybody knows their own financial conditions, and does it make sense to buy a house? And
Right.
rates will probably come back down one day. I mean, we talk about our parents at 18%. They would probably laugh at us if we said, yeah, we're complaining about a 6%
That's
rate. It's all within day to day life. And, I think we were spoiled because rates were in the threes just 6 months
hmm
ago.
Yeah.
And that's a good rate. Everybody, who wouldn't love a 3% rate, but it
Yeah.
wasn't, it wasn't sustainable. I don't think for really economic conditions going forward. So you just work through it. And then,
Right.
again, I hope we don't go to 8% the next time we have this call,
Yeah.
but maybe we're back in the fives.
Right.
Again, 2 years ago we were in the fives, and it was a great rate.
Well, like
So
you said, Timothy, everything's the investment side of it. And when
Yeah.
one of the people that I love reading about and hearing them talk all the time about this kind of stuff, Warren Buffett, everybody knows who that is. He talks all the time about playing the long game. When he invests in stocks, he doesn't invest in what the newest thing is, what has the best potential. He looks at basic fundamentals of
hmm
their price to earnings ratio and how the stability of their company is handled, and then he buys those stocks with long term uh, um, with the idea of holding it for a long period of time. He's
yeah,
not
Right.
trying to sell it off quickly. And I think it's the same principle when it comes to real estate. If you find a house that you like, if it's in a good neighborhood, if it's got good bones, it may not, like Timothy said, renovation loans are great. It may not look cosmetically like the perfect thing that you could possibly
Right.
find. That's the investment of for your future. It's not, renting and paying someone else's mortgage or paying some investment company's apartment complex off is
Yeah.
not helping you build wealth. The clearest and easiest path for the average American to build wealth is through home ownership, is through buying
Right.
a house and holding real estate, because that's the thing that can set you up for the next house you buy, can set you up for
yes,
retirement.
Yeah.
All those things play into role. So just because the rate's 6.5% or 5.5% or 8.5 or 10.5, it doesn't matter, because that's
Right.
always going to have the possibility to change. What's not going to change and most likely not going to adjust is that real estate or that property that
Right.
you purchased is going to continue to appreciate in value over a long period of time.
Yeah. And then can I add something to that as well? I just want to add too, like you mentioned earlier about lawyers and lawyer talk and all that. That's one thing too that really helped me is doing a lot of research and watching things just like this to find out Because there's a time where I was like, man, the market, that just hurt my head to even learn about it or
Yeah.
to hear things. But really, it's like when I'm the type where if I buy even something as simple as a microphone, I research so much. So when it came time to buy my house, that's when I started to kind of research and figure things out. And there's so many things that you can learn. There's so much free information like what we're doing today out there that can really help you get educated into making a really good investment. So, and realizing the focuses on different things, like we get caught up on rates when it should be more the long term, but you have to kind of go out and find that information and really
Yes.
do the research. So,
Well, because most of the news is built off of, fear. They want everybody clicking on
yeah,
things. It's all clickbait. So everything's a bubble. Everything's going to crash. The world's going to end tomorrow because that's how they keep people engaged. But,
yeah,
and there are things, I mean, look, bad things happen. We're in the middle of it right now. But, we
yeah,
thought, I remember calling Timothy right when COVID hit and just being like, oh no, like what is happening? Where is this all going? And even at that point, Timothy was like, just settle down. Like it's
yeah,
certainly not good right now, but the storm passes and we all come out the
yeah,
other side. So, you just gotta, like you said, Raul, you got to do your research. You got to look and see what's out there, what really matters when you make decisions about this kind of stuff. And then just try to do what's best for your family, but you make sure you have all the information. Don't just go off of, what some crazy fool on the internet's telling you, like
right,
us.
like us, right?
One other thing I did want to ask you, Timothy, though, is do you think there's anything on the horizon as far as technology is concerned, like specifically related to things like, decentralized finance and all this kind of stuff that's going to start impacting our world a little bit or changing how money is moved, in our economy? Do you see anything in your hedge and secondary market circles that have your interest peaked?
Honestly, no. I
Not
think
yet.
that not yet. The talk is still what rates are doing, where rates are going. How do you get a par rate? How do who's doing this, who's doing that? There's obviously bigger shops out there. Back to the internet part that might have some misleading quotes out there or what have you. But a lot of right now is just trying to stay. Um, we talked about hedged, just trying to stay hedged and get through this market because it is so volatile. And then I think once we kind of get out of that part, then you'll start seeing, okay, what's the next new thing out there.
Mm-hmm.
All right. Well, is there before we roll off this thing? Yeah, you got anything else you want to?
I will say, I think it is. I'll go back. I mentioned this earlier. Is relationships. So a lot of stuff is technology. A lot of it is just plugging in something into a computer and getting hey, you're approved and all that other stuff. But I do think we always have to make sure that there is always that human factor in there of talking through it, the handshake, the discussion.
Right.
Because I think that is what will set up for future, whether purchases or refinances down the road. Because I think a lot of the stuff does get maybe lost in technology with what's out there, and you could go off a path pretty quick. And so I think it is always good to have conversations about what's going on. And that's why I like having the conversations, because I might not know what's going on in Arlington unless Mike calls me, or what's going on in Baton Rouge or in areas we have branches, and then you call, okay, they're doing this or doing that. And so for me, from the secondary market to the primary market, we have those conversations. And so I would say for the borrowers in the primary market to have those conversations with their loan officers and call and talk and not just try to maybe do it over emails. I'm sorry. That's my.
I think the silver lining in all of this stuff is probably going to be that, when the market does slow down, because it's going to slow down. We were firing it, we were driving a brand new Tesla down the road at 90,000 miles an hour, and now we're going to slow back down to maybe Ferrari speed. Okay, so everybody just relax. It is going to slow down a little bit. There is going to be some pullback, but I think that gets us more to a healthy market. And I think the silver lining for agents and loan officers in the business is that this is going to lead to all of the, what I would call the riffraff that showed up in the business in the last 5 years are going to disappear, because if you're not a professional, if you don't know what you're talking about, if you don't have great guys like Timothy on your team to help you explain this stuff, so what's coming and you can explain it to your customers, then you're not going to last very long in this kind of a balanced market. So I think overall, I think it's going to be great. I think we have to weather the storm a little bit. We have to get through these couple of months of uncertainty. And once we come out the other side, I think we're going to be in a position to where I think as a whole, as an industry, we're going to be more healthy. I don't think we've been healthy for a long time because of free money. And I think it's going to be good for us overall.
Yeah, I would agree with that.
Yep. One last thing I want to mention too is, for our loan officers, definitely reach out to me, because I think like what Timothy was talking about too is just, being able to communicate with technology, setting up some of the stuff is actually a lot easier than what you think. And being there for your realtors, for your consumers, your clients, and being able to be that expert and be that hub that they can go to for a lot of this information is very key. So, I just want to add that in there too. Like, not all technology is bad. We can actually use it for, our gain. So,
it's not going to turn into Skynet and all that get us.
Yeah, no, right. No, but I mean, people think of like the technology of like the automation part of it, and there's like some AI bot that's going to do the transaction of your house. But really, I think I see it more as like what we're doing right now,
Yeah, totally.
So,
all right. Well, that's all I got.
That's it.
All right. Market's good. Everybody's good.
Yes. Timothy saved the day. Look, we talked to him for 45 minutes and all of a sudden we're in a rally. Now, let's be clear. When everybody says,
I think you were probably stalling. If the market had sold off, you were stalling me probably for repricing is probably why you had picked this time frame.
Right. I wasn't going to let you reprice. I was helping all my other LOs make sure we still that's where they were.
Yes. But it's all good.
Well, thanks, Timothy. I do, if anybody's watching still, I don't know if they are, but I do want to try to do this probably once a week, maybe once a month, it'll be more internal on our side, just kind of like you talked about, giving out ideas about different products we have available that are there, different, where the market is, what's happening right now, because, it's one thing to look on the internet, but it's a whole other thing to talk to the guru himself so he can tell us.
All right.
Cool, guys, and give us some feedback too. We want to put this in like a weekly or monthly. Like, let us know what you guys want to hear or how we can improve things, and we can go from there. So thank you everybody who tuned in. Thank you for all the comments. Thank you for everything, guys. Thank you so much, Timothy, Mike. Such a good. I love to do these things because I just learned so much. Like Mike tries to downplay himself as if he's the dummy. Mike knows what he's talking about. I'm the only one here that's just like.
That's only because I talk to Timothy every other day. I told you, like, I call this guy all the time. He's like, half the time I'm like, I expect my phone to be, when you ring somebody and like immediately it sends you to voicemail. That's what I'm thinking most of the time. Timothy's like, and again with this guy.
Cool. Thank you guys so much for your time, and thanks everybody. And until next time.
Thanks.
Bye, everybody.